Over 2.5 million Californians are already delinquent on their mortgage or property tax bills. And analysts warn that by 2026, a wave of owners could be forced to sell just to survive. Hard to fathom, right? The same state that once stood for prosperity, sunshine, and possibility is now pushing homeowners to the brink. Property taxes are creeping up, major insurers are bailing, and mortgage rates are resetting at historic highs. People who thought they were insulated, middle-class families, retirees, first-time buyers, are realizing they're sitting on financial time bombs. California's housing crisis isn't easing, it's accelerating. And for millions, 2026 could be the year the dream home becomes the biggest liability they've ever owned. Number one, the property tax time bomb. For decades, Proposition 13 felt like a shield. Predictable assessments, capped increases, stability for families. Passed in 1978, it was a promise, protection from runaway property taxes. But that promise is being chipped away in plain sight. County assessors are finding new interpretations. Local measures, add-ons, and voter-approved carve-outs slip through legal cracks. The outcome? Higher tax bills. Not as a sudden shock, but as a steady climb, so gradual most people miss it until it hits hard. By 2026, a stack of these changes will be fully phased in, and many homeowners could see annual property taxes double or even triple, especially in Los Angeles, Santa Clara, and San Diego counties. What makes this so dangerous is how quietly it's happening. Cities need revenue for infrastructure, schools, climate mandates, pensions. And property taxes are the easiest lever. Unlike income taxes, you can't dodge them. They're due every year, no matter what the economy does. Retirees on fixed incomes are exposed most. Many bought decades ago when taxes felt reasonable, only to face bills now that rival a mortgage payment. Younger families who stretched during the pandemic boom, even a modest bump can blow up their budgets. At the Capitol, the phrase "modernized Proposition 13" is gaining traction. It sounds harmless. Critics call it a slow repeal, piecemeal changes that unravel protections one policy at a time. For the average homeowner, it means one thing: uncertainty. What used to be a stable cost is turning into a moving target. The psychological shift here is profound. Homeownership has long meant safety, protection from rent hikes and constant inflation. But when your property tax can outpace your income, the foundation cracks. Security becomes stress. Ownership becomes a wager. And for millions, the house they fought to keep could be what forces them to let go. The clock isn't about to start. It's already ticking. Number two, the insurance collapse. California homeowners are facing a disaster that isn't fire, flood, or quake. It's the retreat of the companies meant to protect them. In recent years, major insurers, State Farm, Allstate, Farmers, have stopped issuing many new policies or scaled back dramatically. Why? The numbers don't work. Rebuilding costs have exploded, wildfire claims have surged, and state regulations cap price hikes. Insuring California has become a losing bet. For homeowners, the implications are stark. Even if you've never filed a claim, premiums are spiking. Coverage can vanish overnight. Many are being forced onto the FAIR Plan, the state's last resort pool, which costs more and covers less. Insurance used to be the invisible safety net that made ownership viable. Now it's fraying. In high-risk and rural areas, premiums have tripled since 2021. People paying $2,000 a year are getting renewal quotes for $7,000 or more, if they can renew at all. Others are being dropped with a single non-renewal letter citing catastrophic risk. Ironically, some of these zones haven't seen major fires in years. The issue isn't just risk, it's profitability. Insurers can make more elsewhere, and California's consumer rules make walking away easier than adapting. This vacuum triggers a chain reaction. Without coverage, you can't refinance or secure financing. Buyers avoid uncovered homes. Demand slips. Prices follow. It's a slow freeze that eats into values and homeowner confidence. The emotional toll is massive. People who felt safe now live with a persistent fear that a spark, a storm, or a letter could wipe out everything. Homeownership has always been tied to the promise of protection, but that promise is dissolving. leaving millions exposed and anxious, wondering how long they can hang on before the system itself gives way. Number 3, mortgage rate shock. In 2020 and 2021, buyers surged in. At a hill, ultra-low rates, remote work, the belief that prices only go up. It felt like the moment to jump, but the come down is here. As interest rates climb to multi-decade highs, thousands are confronting a brutal reset. Many didn't lock a 30-year fixed. They took ARMS or short-term refis with teaser rates. Those terms are ending. Over the next few years, especially by 2026, state and local rules will compel costly upgrades to meet tighter safety, environmental, and energy standards. Think seismic retrofits, electrical panel upgrades, green building compliance, water conservation measures. Necessary? Often. Affordable? Not for many who are already stretched. Take seismic retrofits. Older homes, particularly pre-1980 builds, may need $10,000 to $50,000 in work. Green mandates add more. Solar requirements, heat pumps, EV-ready wiring tied to renovations or sales. A roof replacement can snowball into a solar project, turning a routine fix into a 5-figure outlay. Homeowners face an impossible choice: comply and sink deeper into debt, or delay and risk penalties, code enforcement, or insurance non-renewals. Notices are already hitting mailboxes in parts of Los Angeles, San Bernardino, and the Central Valley. For retirees and longtime residents on fixed incomes, these mandates feel like forced spending. With values softening, few can recover costs on sale. The irony is sharp. Reforms meant to create safer, greener neighborhoods risk accelerating displacement. Affluent owners can adapt. Working-class Californians get priced out of compliance. Homes that once embodied pride and stability are becoming liabilities in a regime that prioritizes regulation over reality. By 2026, California may not just be modernizing infrastructure. It may be uprooting the communities that built it. Number 7, the exodus of buyers. California housing ran on one crucial fuel: demand. As long as new buyers kept coming, prices rose and confidence stayed high. That flow is weakening. High rates, inflated prices, and collapsing affordability have sidelined an entire cohort of would-be homeowners. Young professionals who once saw California as the finish line are leaving in record numbers. From 2020 to 2024, over 800,000 residents moved out, taking demand with them. The outcome: listings linger, price cuts proliferate, open houses turn quiet. Builders pause projects, agents struggle to close. Property tax receipts sag, pushing local governments to hunt for new revenue, often from the same homes owners already under strain. Investors who feasted on California properties are redirecting capital to Texas, Arizona, Florida, places with lighter regulation, lower costs, and better cash flow. The gap that's left isn't just economic, it's psychological. When faith in the California can't lose narrative fades, the market's engine, confidence, stalls. Sellers discover that moving a home takes time, concessions, and price givebacks. The bidding wars are gone. Equity that felt secure is thinning out. Landlords who counted on rent to cover rising costs are finding more vacancies as tenants decamp out of state. The most unsettling part is the feedback loop. More departures mean weaker demand, softer prices, and rising fear, driving more departures. Not an explosive crash, a quiet unspooling. Number 8, the 2026 correction window. Every cycle has a breaking point. For California housing, many believe it's 2026. Economists, lenders, and market analysts are pointing to a correction window, a period when multiple pressures converge into a mass sell-off. Not a sudden implosion like 2008, a slow bleed powered by years of built-up fragility. Property taxes climbing, insurance premiums ballooning, ARM resets hitting, values sliding, all on a similar timeline. By late 2025 into mid-2026, thousands of households may hit their limit and accept what they've been avoiding. Keeping the house no longer pencils out. The seeds were planted during the pandemic, Buyers paid top dollar at bottom rates, believing they locked in safety. Then rates rose, inflation lingered, and values softened. The foundation shifted. Now debt loads are at records while equity evaporates in the background. Layer on tighter rules, rising energy and maintenance costs, and fewer buyers, and you get what some call forced liquidation. Owners won't sell because they want to. They'll sell because they must. Lenders see it coming, prepping for more refi failures and delinquencies. As ARM resets collide with expiring forbearance and dwindling options, distressed listings rise. Investors are waiting on the sidelines for better entry points, a self-fulfilling slide that pushes prices down first. This isn't hype, it's arithmetic, and the psychological damage could outlast the financial. Selling a home isn't just a transaction, it's surrendering pride, progress, and a sense of belonging. California has long sold the idea that dreams live here. 2026 may be the year many realize the dream has quietly been repossessed. The correction won't only move prices, it will reshape what ownership means in the Golden State, recasting the California dream into something more sober. Payments are spiking. By 2026, millions could see monthly costs rise by hundreds or even thousands. What felt manageable becomes untenable. The pain is sharpest for those who bought at pandemic peaks. They stretched, overbid, assumed low rates would carry the dream. Now they're boxed in, can't refinance at higher rates, and can't sell without taking a hit as values soften. Economists call it mortgage whiplash, too strapped to stay, too indebted to leave. The result? Households living paycheck to hold on to assets that don't feel like assets anymore. It echoes 2008, not in sudden foreclosures, but in slow burnout. Instead of headlines, you get quiet exhaustion. Deferred repairs, second jobs, cutting essentials to keep up with the reset. The emotional weight is heavy. When you realize the house owns you, something deeper breaks. Banks are tightening standards and limiting refi options, closing off exits as resets chew through savings. It's not just a financial squeeze. It's a psychological unraveling that could normalize forced sales, one mortgage statement at a time, as 2026 approaches. Number 4, declining property values. For years, California housing looked unstoppable. Prices soared, equity ballooned, investors piled in. The Golden State looked invincible, but the tide is receding across the map from the Bay Area to Sacramento to Los Angeles County. Prices have slipped 10 to 20% from pandemic peaks. For those who stretched to buy in the frenzy, that's not just disappointing, it's devastating. Many now owe more than their home is worth. Underwater, panic territory, the causes are intertwined. High mortgage rates froze the market. Buyers are priced out. Owners won't sell, hoping the math changes. Stalemate. Add tech layoffs, remote work reshuffling, and population decline. And once red-hot hubs are cooling, fewer high earners means less competition. Less competition means falling prices. Investors are rotating to states with lower taxes and higher yields. The boom begins to look fragile, a bubble stretched thin by leverage and optimism. This downturn is uniquely psychological. Real estate here isn't just shelter, it's identity. A home purchase signaled progress, status, security. When values fall, it hits morale. Owners delay maintenance, dread appraisals, and watch the illusion of wealth fade into quiet anxiety. Retirees see years of equity, their future, erode. New buyers feel trapped in a bad trade, unable to move or refi. And as values fall, consumption falls, and tax revenues shrink, feeding a wider slowdown. California doesn't need a crash to hurt. A slow drift lower can do more damage by eroding confidence, 1 month at a time. Number 5, new state and local fees. Californians have long accepted high taxes as part of the deal. But what's happening now goes beyond taxes. It's a stealth squeeze, a patchwork of new fees, assessments, and surcharges that don't make headlines but drain bank accounts. Across the state, cities and counties are rolling out charges tied to ownership, infrastructure fees, wildfire protection assessments, environmental impact contributions, school parcel taxes, climate resiliency surcharges. Individually, each sounds modest. Together, they grind down households. The logic is blunt. Municipalities are broke. Years of deficits, pension obligations, and deferred maintenance have left budgets in the red. Instead of raising marquee taxes, they slip in localized fees that require limited voter approval or none. That $200 neighborhood charge morphs into a $600 climate adaptation fee, nearly unnoticed. These fees recur and compound, tightening the vice each year. By 2026, many of these policies will be fully operational, pushing even stable owners into stress. The most dangerous part? Invisibility. Most people don't connect these small, recurring deductions to the broader financial strain. They budget for mortgage, insurance, utilities, not for a dozen line items labeled improvement. The cumulative effect is staggering. A few hundred here, 1,000 there, until families wonder where the money went. For retirees and working-class owners, these fees can tip the scales from staying to selling. They often support the goals: safer neighborhoods, greener cities, stronger schools, but they can't carry the pressure. In a state that taxes income, purchases, and property, these layered charges become the last straw, reshaping lives quietly, one bill at a time. Number 6, the aging infrastructure crisis. California's beauty masks a harsher reality. Much of its infrastructure is old, brittle, and overdue for replacement. Roads, bridges, power lines, water systems, and homes built mid-century are aging out. Instead of steady upkeep, decades of neglect and budget gaps left them to decay. Now the bill is due, and homeowners are being told to pay it. The California lesson: where do you land on this? Is California edging into a slow-motion collapse or just cycling through another painful reset? Drop your thoughts below. And if you haven't watched our previous video, check it out. It ties directly into this. We put an enormous amount of time into research and production to get past the headlines. If you want to support the work, hit subscribe. One click means everything to the channel.